episode talking about some of the stuff that's been going on this week. So what happened today? We had FOMC meeting today where Jerome Powell spoke and he decreed that there shall be another rate hike of 25 basis points today. And it wasn't a big surprise because everyone was expecting another rate hike. It might have been a big surprise in January when no one was expecting any of this to happen. It was interesting today that it didn't rule out rate hikes, as in 2 more rate hikes. The question is whether or not he was going to pause or accelerate more rate hikes and how this will impact the economy. It was interesting today that their forecasts for the economic future of the United States were very much so bullish. They thought that there was possible, I guess that's been their narrative all along, but possible that they can land the plane between the rock and the hard place, meaning we may be able to crank rates harder and higher and not go into a recession. So that was headline news today. The market didn't like the fact that it's very much uncertain how the Fed will behave in these next little bit of months, minutes. This is going to be a shorter stream than usual because my daughter dropped my phone in the bathtub, and so it is soaked in water and it will not let me charge. I plugged the thing to charge the iPhone, and because there's water in the port, it's fine because they're waterproof phones, but it says you can't charge it or you could risk doing damage. So I can't plug my phone in right now because it is water soaked, but thankfully it's a sealed unit, so should be just fine. But yeah, so it'll be a short stream tonight because I think I had around 25% battery when I started this stream. So I don't know how long we can do it, but probably 20 minutes, 30 minutes maybe at best. Maybe we'll get 40 minutes out of it. We'll see. So keep those questions coming. I'll do as best I can to get as many of them through as I possibly can. But yeah, that was the big headline news for today. We've seen a bit of a pullback on the NASDAQ, but then Facebook earnings dropped and bam, all of a sudden it was, market started rallying again. And leave it to Meta because Meta's been my favorite company. I bought them at $92 a share in December. I called it on my live stream. I was like, this is amazing value. And I sold them $120 something a share. And it's 320 and rallying. 300% gain on Meta. Nvidia, almost 300%. Like all these companies up several 100%. To me, too bullish, too much hopium, too much printed money out there. Everyone just has money. They're just rich. There's a lot of money going around. And then all these stocks tripling in value, these mega cap companies like Google and, Meta especially, Nvidia and a number of other names, Tesla. It's like all these names are creating more money. And so what will that do? When you give a bunch of people some artificial gains, they're going to spend. And so how do I think the inflation reports are going to look on July's data coming out in August and August's data coming out in September and September's data coming out in October? I think it's going to be a resurgence of inflation. We've got a number of things that are going to drive inflation back up for a little spike before hopefully we can stave it off. But I think it's very likely that the gas prices 1 year ago, now they had fallen. So the last inflation report looked really good at 3%. It's because gas prices were 30% higher, 35% higher. So that affects transportation, that affects the cost of goods sold. Everything is just jacked up by that. But when gas prices fall, and what we're seeing with the earnings season, if you look at all these companies' earnings, they're all beating earnings. Every single quarter, it's like every company is like crushing earnings, more profitable than expected, beat profit, beat on revenue. And that's telling me that people are still spending. Companies are still spending. They're spending on ad revenue. They're spending on a number of things. So consumers are healthy, I think, in a lot of ways. And so that's a bad thing, right? Job growth, also technically healthy. Now, if you remove the government sponsored jobs in construction and public service and all of that, jobs report isn't good. So a lot of it's being propped up with tax dollars, but I guess we won't get into that now. That's the quasi neo-capitalist socialist system that we currently live in. But they are stimulating the economy quite a bit while they're raising rates. So potentially we could get through this without a massive recession. I think we're going to see much more pain in the coming months. There are a lot of people who aren't invested in the stock market. And I'm talking about the bottom half of society that doesn't have any stock investments. It's a couple grand maybe in the stock market. They don't care if Meta shares or Nvidia shares go up 300%. It doesn't affect them at all. What affects them is that groceries are still at 9% inflation. Over the last 2 years, the cost of milk and meat is up 20, 30, 40% in some cases, depending on the type of food that you're buying. The rent is up 20, 30% over the last 3 years, and they're feeling that, and that's real. And that bottom call it even bottom 2/3 of society that's struggling, they're about to break. And I don't know how they're hanging on right now, but they're still hanging on. And if you look at credit card data, we see per capita in the US and in Canada, it's at all-time highs. It's growing by 19%. What that tells me is that the credit card rates are 17, 18%, that they're actually not paying off any debt. And the debt is accruing, the interest is accruing, and it's potentially going to culminate in some sort of collapse, which is good because it will bring rates down. There needs to be blood in the streets to bring rates down. I think the problem is there's too much euphoria still in the market, and we need some resurgence of inflation for them to go higher on rates to break the economy. When they break it, then they can drop rates. So for a time, this is actually probably, not a terrible time to start buying quality assets like real estate. And real estate right now, especially in Ontario, is beat up. You got properties sitting on the market for 30, 60 days, no offers. They're priced right. You could drop them 10% below appraised value. They're still not selling. There are not a lot of buyers right now. Everyone's afraid. And even if there are buyers, who can qualify when your home equity line of credit is at 8%, right? Prime plus one. We're 7.25% right now in Canada. We may go 7.5%, which will make us 8.5% on a home equity line of credit to start. And commercial loans are prime plus 2 in many cases, sometimes prime plus 3. Unsecured lines of credits and business lines of credits are prime plus 4 in a lot of cases. So we're talking 10% interest. Who can get a deal done at 10% interest with these valuations? Prices have to fall or rents have to rise, and rents are at a ceiling. They can't go any higher. People can't afford. So what has to happen is prices have to fall. And we're seeing that. We're seeing a lot of this commercial stuff just sit and no offers. And the sellers have to wrap their head around the fact that we aren't where we were a year ago and that prices have to come down a little bit. And when you're talking about trying to sell a building with a 4 cap in downtown Toronto or a 3 cap, and you have to borrow money at 9, why in the earth, why would anyone apply a leverage at 9% to an asset that returns 3? Cash flow. I mean, unless they're thinking of depreciation is going to make up the gap, make up the difference. Maybe, I don't know. The interesting thing though, is the people that do that in these times where no one is buying, that negotiate ruthlessly and do apply leverage now, during the times when it's most expensive, especially variable debt that will float back down next year into 2025. Also, just interesting aside, today, Jerome did say he's forecasting we're not going to return to the 2% target of inflation until 2025. It will be a battle until 2025. His own words today. That is the most bearish thing I've heard, because it was always 2024, but they just keep moving the goalpost. In 2022, it was like, oh, it's transitory. 2021, sorry, at the end of 2021, it was transitory. It started to spike. Then in 2022, like, hey, it's still transitory. Supply chains coming out of COVID, they got an excuse for it. Okay, but by 2022, end of 2022, we're gonna start bringing rates down. Into 2023 for sure. 2023 comes, like, you know what? End of 2023 for sure, rates are gonna come down. Like, no worries. Definitely rates are coming down. Like, lever up, it'll be okay. And now it's like 2024. Maybe it's gonna be 2025. I don't know. The goalpost keeps moving. And it's like, I don't know how people are carrying right now the weight of this extra debt. A lot of these businesses are levered up, and it's problematic, I think, to say the least. This could result very poorly. But so far, so good. I mean, the government has been stimulating the economy, creating jobs. Private sector jobs are being crushed. Thankfully, people in tech and in several sectors right now that are booming, like all the AI sectors, any business that can apply that. Even oil and gas now is making a resurgence. Interestingly, how is that going to play out? Let's think about that. If OPEC has decided to reduce supply, Russia has come out and reduced supply and potentially chokeholded Ukraine's supply of wheat and grain. I mean, how's that going to play out for the price of food and the price of gas? But if you raise oil, and if you raise oil, what does that do to the cost of all of our goods that we ship in various trucks and ships? All of that requires fuel. So the price of everything just goes up. And so potentially this winter, as gas prices get squeezed, we could see a resurgence of inflation. I think that's a really likely scenario. It's probably as likely as a flip of a coin. So would I be bullish right now on stocks that are at 300% increase in valuation since last year? No, I'm actively shorting. Now, I'm not going crazy on my shorts. I've pulled them back a little bit, and I continue to want to pull back. I have certain metrics that I've set for myself where I will peel off the short. That's just from a risk management perspective, both at a perspective of like, if I'm wrong and the NASDAQ rallies to 400, or if I'm right and it continues to pull back into the trend that it started on now, which is correcting, if we get back into the 360s and into the 350s potentially, I think there's going to be a real opportunity, I think, to pull some risk off the table for me and just to stop trading. Because honestly, I don't want to keep up with it. I want to focus on my business. I want to build my business in real estate. I like building a business around that where I have a competitive advantage, where I can build something that I can control that's tangible and that just in general outperforms anything I can do with trading from a risk-adjusted return perspective. All right, I got some questions here. Let me just jump to those for a sec. Could you use a wireless charger? I could, but I don't have one. So I don't like wireless charging. I don't like getting, I'm a bit of a tinfoil hat hippie person, I guess you could say, because I don't like the wild free radiation that you're getting off electricity. I even when I plug my phone in, I stay away from it just because I don't want that energy. I'm the kind of guy who sleeps with airplane mode on his phone because I don't want the brain being fried 3 feet of me. Joe says, I heard that immersing wet electric items into rice can absorb the water and dry it out very well. Joe, I've done that. Yeah, I've definitely used the rice trick. It does work for sure. But I had my show, so I'm using the phone that I shouldn't have because it fell in the water like 30 minutes ago. But the show must go on, as they say. Here we are. Hopefully I don't break this. If I do, it's like, hey, there's an excuse to get a 14 Pro Max. Mark says, hi, Mike. Is now about time to use leverage to buy low fee indexes for long term and slowly pay off the loan? Mark, I don't know, but I would say yes. I would say applying leverage going into potentially, well, we're currently tightening and the yield curve is inverted. So every time historically we've been through a situation like this, there's been a lot of volatility. So what that means is if you lever up a lot and we have, and let's say you're long the indexes and we have a 20% pullback on the NASDAQ or on the S&P 500, which it could happen. That's actually possible. If that happens, what happens to your portfolio? If you had $1 million portfolio and you levered it up with a 700K loan against it and it became worth, 20% drop is 800 grand. So it was 800 grand. Now your 70% loan to value is worth 560. So you're short, right? You're short 140,000 that you have to now sell at the bottom, which is when you want to be buying. So leverage puts you in a situation where you're forced to make bad decisions potentially to cover more bad decisions. So leverage just amplifies the outcome, right? And the nice thing about non-levered holding of indexes is that you can hold for the long term and it's okay. So my thought would be this: apply a little bit of leverage. If you're going to do that, I think you're buying in at a high. I think we're going to see a correction this fall as inflation resurges. I think there'll be one more time where we get to buy, and it won't, I don't think, hit the same bottoms we saw about 8 months ago or whatever, in December. We're not going to get that same bottom. We might try to test it or get close to it, but I don't think we'll pierce it. I thought there was a chance we might, but less and less. I think there's a good chance we actually come out of this all right. And the system's designed that way. The election's coming up at the end of next year. It's very likely that things will be okay. It's also very likely to go to war. For the Democrats to hold on, it's a trick they like to use. They like to go to war because no one wants to change presidents mid-war. But so keep out for that because historically speaking, that's something that has happened. So tensions between China and US, Russia, next year a lot could happen. And the VIX is pretty low. So there could be a play there too, buying some calls on the VIX like a year out could potentially play out for you as long as you dump those as soon as you have any negative catalyst. So you wait for those days where there's going to be something. We've been so long where the VIX is like 13 or something. It's like getting down to normal. And so we're only a match away from it jumping back up to 20. So that could very likely happen. So yeah, that's what I'll say about that. I would say that just be careful with leverage. Leverage is a great tool. And when you're buying against cash flowing strong assets, it can be a great way to amplify everything that you're doing. But low cost debt is important against strong cash flowing assets that self-service the debt and they're non-callable ideally. Real estate's non-callable. The value of your property falls, your cash flow positive, you make your payments, they don't care. In the stock world, the value of your stocks fall, they will force you to liquidate at the bottom at the worst time possible to cover the loan. Real estate doesn't do that, it's non-callable. So that's the difference. It depends on how. Like if you have a business loan on your business and your business falls in value, they're not coming there and sending appraisers in to value your business. So that's why business loans are fantastic, right? Like that's probably the best way to build wealth is to build businesses or to buy businesses and build them. It's the fastest way to build wealth. It's almost how every billionaire was made. So that's just food for thought, I guess. Very, very, very few, other than like George Soros, billionaires out there were made through trading. Like you don't trade your way to billionaire. Like most people can't even outperform the index over the long term. They may outperform for a number of years, but then they blow their account up. And so if you average out over a long period of time, there's a reason why you shouldn't use leverage and you shouldn't short. Is because people who do that, when you study them, they lose to the index over the long term. And like, here's me not taking my own advice, but I'm going to start trying to take my own advice. I don't like to listen to reason sometimes when it comes to my own portfolio, and I really should. A perfect example, you guys can learn from me what not to do with leverage. Leverage is great on real estate. I've never had real estate debt be called on me, right? So that's helpful. Whereas you get called at the bottom with stocks. So, next question was currently not cash flow positive on any of the properties with variable rates. That sucks. Sorry to hear that. You put 5% down. So that sucks too, because now you can't even sell the properties, because if you put 5% down, the way that 5% down structure works is there's PMI, private mortgage insurance, and PMI takes 4% of your 5% down payment. So 80% of your entire down payment was eaten up in fees if you sell the property tomorrow. And you have realtor fees, 4 or 5%. You've got lawyer fees, other closing costs. So you're going to lose probably, if you put 5% down and then you go and try and break out of that mortgage, you're looking at maybe losing 10% of the value. And that's if the property hasn't fallen in value, which we bought in the last year, it has fallen in value. So you probably lost another 10% to the market fall at least. So you're looking at losing 20%. And if you put 5% down, that's a 400% loss. So to think about, I don't recommend the 5% down strategy unless you plan to hold for the long term. The play with the 5% down strategy is you don't want to refinance it, you don't want to add value to it, and you don't want to sell it. Because if you refinance it or you sell it, you're screwed. You lose all the benefit that you got from paying that huge upfront fee. And I know a lot of real estate investors pump this 5% down strategy, and it's like, man, just borrow the other 15% from family, from anywhere. It's cheaper. Loan sharks at 15% interest is cheaper than the fees they charge you to set up that 5% mortgage, and they build it into your mortgage. So you only pay it. Well, I guess you pay it right away, and there's interest compounded against you on the mortgage balance. But if you sell, you lose the benefit of that, and you have to pay that huge fee. So something to keep in mind. I'm not a fan of the 5% down. There are very few scenarios where it does make sense. Sometimes I've had students come to me and say, hey, like, does this make sense in this situation? I'm like, it's turnkey property. You're not going to sell it for 5 or 10 years. You can get a lower rate because you do the 5% down. They'll subsidize your rate because there's private mortgage insurance. Sometimes your mortgage rate's a little bit lower. There's no refinance play, no equity takeout. You're not going to sell it. You have no options. You're locked in. But if you're okay with that, the 5% down is pretty cool. So with a 5% down deal, you have no options. Otherwise, you guaranteed lose most of your down payment right off the bat in fees, which is brutal. So I'm sorry to hear you're in this situation. I would say that the best situation is to hold, because again, you're now on this ride. So you might as well see the ride through. It sucks that it's variable. You said you're able to sustain the small monthly loss. That's great. I think that we're going to have a really good opportunity to grow our real estate portfolios over this time. And I'm buying into this dip this winter. And so I think there will be, I mean, maybe not the best time to sell, maybe not the best time to buy right now either, but it's going to be a good time to buy. And so if you can hold through this time, we're going to come out in 2026, I think, roaring, and you'll be glad that you held. So hold, find a way to cash flow it. Maybe you can take a unit and put it on Airbnb. Maybe you can rent it out with a bedroom to students. There's lots of ways to crank your property. Whoa, 10% battery. There's lots of ways to crank your property so that you can squeeze out some cash flow in these tough times. It's going to require a little bit more work, but it's probably less work than selling it. So find ways to increase the cash flow. Could you build an ADU? Could you build a shed in the backyard and rent it out for $100 a month for storage? A heated shop shed or something. You know, you could build a 10 by 20 shed with a permit that's just there for storage, and you can rent it to a contractor who wants a workshop or something. Throw a little heater in it. Boom. Anyone can put a shed in their backyard with a permit. You could put an ADU that's more expensive, but a shed's like $5,000 to pour a slab and put a shed up. Like, that's super easy, and it could create some cash flow. So there are ways potentially that you could work on getting more out of the property that without a lot of extra capital. So think through those scenarios. Maybe there's a way to squeeze out something. There's always an angle. You just got to figure out what the angle is. Joseph says, hope all is well. Wanted to ask your opinion on how many flips a seasoned investor typically should be doing a month, and how long should it take for the flip to get under contract? So it really depends. There's no like set rule. I've had times where I've done nothing for a couple of months because the right deal hasn't fallen in my lap. There's times where I've picked up 5 deals in a month. How long does it take to flip them? It should take 6 to 8 weeks to do a project from start to finish if you have a good crew. But if you're spread thin like I am and you have like 10 projects on the go, it might take you 6 months to get all those done because you're moving them all a little bit at a time. And so like I have too many projects on the go right now. And like my current challenge is operationally. We have 6 good people that are pounding me on the flips, and I probably need 10. So if you guys know of a contractor who wants a job full time, dedicated, working on our projects and does interior renovations and that's their thing, and they're like a journeyman or whatever, and they can do like bathroom renovations, they can do floors and tile and laminate and paint and all of that, and that's their skill set, I mean, have them reach out because I am hiring and I will happily pay like, I mean, honestly, for a decent contractor, they can get 70, 80, 90, 100 grand a year and they're well worth it. So in this scenario, you sometimes don't want to cheap out. You get a good guy that does it right. So anyway, if anyone knows of anyone, send them my way because in London, Ontario or Sarnia, I'm hiring right now. But yeah, it's a current bottleneck for me. And it's like, I just took too many projects on all at once and they're mostly almost done. So it's okay. And I have, good people and they are working hard. I don't want to throw any shade at the people that we have. Like they're doing their best and there's just a lot of work to do. Depending on the scope of the project too, like some flips, you can finish it off in 3 weeks, nice and quick. Some take 4 months. If you're doing a permitted ADU in the city of London, you're looking at 2 months just in permits and then 2 months in inspections, right? And then the work itself, if they have a number of inspection deficiencies, may take you another 2-3 months. I've seen really seasoned, good builders and developers battle on properties for a year with the city, 2 years, even on some development projects, 3 and 4 years. So it depends on the type of flip that it is. If it's a big multifamily project, it may take years. Usually it does take years to see that whole project through. If it's a triplex, it might take you 6 months or a year. If it's a quick single family flip, you might be in and out in 6 to 12 weeks, but budget another month for trying to sell it, budget 2 months for closing window. So the project in total will always take at least 6 months. Like no one's date of under contract to date of sold in under 6 months. Like it's very rare. You're under contract, you're a month till you close on it, you get in there, start doing your work, you're a month or two, then you post it for sale, takes 3-4 weeks to sell, then they want 2 months till their closing date. It just takes 5-6 months. It's just how it is. There's, people saying they're flipping a house in a month. It's like the only way you flip quick like that is you wholesale. And the idea behind wholesale is like you literally get the property under contract and you sell the contract, the right to that property, and someone else takes on the project. That is quick, easy cash because you don't close in your own name, or if you do, you just double close and you're doing nothing on the property. And that's if you have a buyer lined up. That's super key. Most flips don't. Most flips don't have a buyer lined up. But if you can get a buyer lined up beforehand, that can significantly reduce the window and increase the churn on your capital or the velocity of the capital, which is how you make the best ROI possible. And that's a lot of stress. So most people prefer the buy and hold approach. And I'm still a fan of that approach too. Next question. What order should I fix my credit to 800 by this year? I know how to pay debt off first, then what's after that? So just go watch. I have a video on that, as you mentioned, that talks about the different weightings for your credit score. So examples are like credit utilization. What percentage of your credit is being utilized? If you're using 0% of your available credit, it's actually bad for your credit score. If you're using 70% of your available credit, also bad for your credit score. You want to be in like 20 to 30% range. So if you have $100,000 in debts across lines of credits and credit cards and all of that you could be using 20 or 30% of that on a monthly basis is a good user of credit. That's what they want to see. They want you to be using it to give you a good score. Other things like paying on time, obviously, always pay your balances off in full. Anyway, go watch the video. There's a whole video on that. But credit score isn't as important as you might think. It is a useful tool. And there's been times where I've had like an 870 credit score, near perfect. And there's been times where I've had a 700 credit score. But when, like, as an example, when I applied for like 7 or 8 mortgages at once, when you put in applications, if you're buying 5 properties and you have applications out for 2 or 3 options for every property, because you always want to have an A option for financing and a backup option for financing. So they're going to hit credit each time you apply. If you have 5 properties, you're a successful investor, you may have 20 or 30 hits in your credit score, which for 30 or 60 days will take your credit score down to like 700. Then it'll bounce back. So like, I would say if you're using your credit score properly to lock up deals, and the point of having credit is to get good interest rates and to get qualified to borrow money. So if you're not borrowing money, what's the point of the credit score anyway? Like, who cares if your credit score is 900 or 600? If you're not using it, it doesn't matter. You should use it. Credit score is an important tool in the toolbox as a real estate investor because leverage is what makes real estate so sexy. That's why we love it, because it's non-callable debt. In the stock market, you get called on your debt. In real estate, they can't call it. You buy a property for $1 million, you put an $800,000 mortgage on it. Doesn't matter what the value of that property does, as long as you make your mortgage payment every month, it never gets called. That's so key, so key. And the fact that you can borrow, like, currently in Canada, you can still borrow at 5.5%. Your 5-year fixed mortgage right now is like 5 and a bit, 5.5 in Canada. So like you can borrow at prime minus 2% right now on real estate, especially for residential. You can go on some of the large multifamily stuff. They're still subsidizing. CMHC is still subsidizing at like 4.99. So you can borrow still pretty cheaply. So real estate is sexy because if you're buying in areas with good cap rates, where you're buying 10 cap rate buildings and you're borrowing at 5, there's a huge spread there. That's your profit. If you bought that in cash, you wouldn't get any of that. That's the sexy part of real estate. All right, I'm off the podium for that point, but I think the point's been hammered home. Favorite kind of music to listen to? To be honest with you, I like a little bit of everything, but I like my pop hits. I like my classic rock. I grew up on like rock and classic rock and stuff like that, and some heavier stuff too. One of my stepdads for a while, my foster dad, he was into like Godsmack and like Iron Maiden and like heavy stuff. So there was a time where I was into that, just because I grew up with that. But I love my classic rock too, and I also love pop. I like country once in a while too. I don't like any of the screamo music. People are into that. I can't get into it. It's like, there's a funny Instagram reel guy that I watch sometimes, and he sings screamo, and it's really funny because he says the most stupid stuff like, "Go get a job," and it's like that I find funny, that I enjoy. But no, I like rap too. Like I'll listen to, I like a lot of rap stuff is good as well. But I like your Russ or your Eminem, your motivational stuff. I don't like the, fuck bitches and whatever. I'm not into that stuff. But whatever. Like I like most music, just not the screaming stuff. I like real music. Corinder says, "Hey Mike, hope all is well. Are you buying any properties right now or waiting?" I'm always looking to buy. When I finish the projects we're on in the next month, I'm going to need some more projects. So if you guys know of any larger multifamily projects in London or Sarnia, send them my way. I am hungry for some big projects. So send them our way. Nice thing about large multifamily is I can buy it under contract now. It closes in 60 or 90 days. All my projects that I'm currently on will be wrapped up by then. I need new ones for the guys to transfer into. So I will be going into buying season again just to keep my crews busy. Yeah. And yes, I think it's also a good time to buy because, again, there is just not that demand. Just not that demand right now. It's just a lot of supply building up in the market and people aren't buying. Jazzraj says, thoughts on Hamilton real estate and growth prospects for the city. I mean, Hammer is rough, right? Like Hamilton is one of the rougher cities in Ontario. It's right up there with Windsor. It's a steel, rough blue collar steel town. No, Hamilton's not that bad. I mean, I don't know. Will it grow faster than, say, Toronto or London or other neighboring cities? I don't know. Probably not, to be honest. But again, it could be gentrified in a way that would allow it to grow faster potentially. Does it have better cash flow? Yes. Than, say, Toronto proper? Yes. But that's because it's Hamilton. I'm not an expert on the area, to be honest, but I've looked at property there before and I keep an eye out. Bryce says, hello from the Northwest Territories. Hello, how are you? Thanks for tuning in the stream tonight. Afghan says, love the YouTube consistency you've got going on. Thank you, appreciate that. I've done it every week, a live stream for the last, 2017. So like 5 or 6 years now. 2017, 2018, and sometime in then. I was doing lives on Facebook every day, I think in 2017. 2018, I started doing the YouTube hard. Graham Stephan kicked off one of my first ones. It was like Monday Madness, and I changed it to Wise Wealth Wednesday, and now it's just the Mike Rosehart show. But the Wise Wealth show on Wednesdays was something I didn't want to give up on. And even though I've given up on making videos on this channel for now, it's not given up. I've taken a break. I have other things that I'm prioritizing right now. And I could go back to making videos again and go viral and I'll do all of that. I continue to make these videos because, one, I enjoy making them. It's something that I said I would do, and I like to show all of my investors and all of my students and people that follow along that consistency is key. If you never give up, you never lose. You only lose the game, the war, if you give up. That's it. You can never lose if you never give up. It's like, I'm still working towards X and Y goal. So you just never lose. So that's also part of who I am. And so that's part of why I haven't given up. I'm also a stubborn goat, as people can see from my short that I continue to hold all this year. As you can see in my real estate projects and businesses, I don't like to give up. I like to keep going. And I find, even when I fail, I find a way through it. And because I don't give up, I continue to push through it, I eventually win. And so, never give up, keep going. That's why I keep going every Wednesday, 7 to 8 p.m. I've had COVID twice and been on. When I had COVID, I had holidays, Christmas, whenever, it's every Wednesday. So whatever the Wednesday falls on, I think I went live. I've been up for 36 hours. I think one of my streams a couple years ago, one of my kids was born. I was in the hospital and we've been up for like 2 days. I still went live. It's like, I just had a child, like no problem. There is no excuse to not go live if you prioritize it. It's like, what else should you be doing? What am I doing right now? I'd be on, like on my phone, chilling, maybe having a nap, hanging with my kids. It's like, I have to sacrifice something. Whenever you say yes to something, you say no to something else. And so I continue to say yes to this every Wednesday. And hopefully you guys get enough value that it's someday, I'll be happy that I did it, hopefully. So I continue to do it from now. And the second part of your question was, have you talked about the CVNA short? I haven't a great deal, and it's because I don't want to promote shorting. I am short CVNA. No, I haven't talked about it, just because I don't want to encourage bad principles. The foundation of financial independence and this channel is about diversification, risk management, hard data supporting all of the theses that, oh, hey, how's it going? I didn't recognize the name, but that's what I built this channel on, was that, right? And the idea of leverage and shorting is not something I want to promote on this channel. I just believe fundamentally, and the data supports this, very, very few people can outperform the index over the long term. And so I am an index fund junkie, and I would promote that to all of my followers. Even if you could, not you specifically, but I'm talking about people watching this in the replay. People are going to watch this replay. It's like, even if you could develop an edge and develop some alpha on the stock market, it's so fleeting. Like if you take a break for a month, or just like the amount of time you have to put in to develop that edge, is it worth it? And like, I don't know very many people who have traded their way to great success. Like billionaire, I don't know of any. But in real estate, there's lots of people who have made it to billionaire. As business owners, if you can build a business around it, okay, that's something else. But most of the people watching this are working their job and saving, and it's not worth their effort to try to beat the market. Be in the market. If anything, maybe apply, half a time's leverage. So if you have $1 million portfolio, borrowing $200,000-$300,000 against it would give you a great amount of exposure with very little risk to the S&P 500, like, your Vanguard ETFs. There's tons of low cost ones. There's also like VTI, like World Index. You get exposure to many different places and get a little piece of every stock market. That would give you a lot of diversity and safety and comfort. Over the long term, you would do really, really well. With real estate, it's hard to lose. So when I teach, buying a rental property, or I teach, like, there's very few people over the long period of time who come back to me and say, hey, I've done real estate for 5 or 10 years, Mike. Very few have lost money. I know lots of people who have traded for 5 or 10 years and lost everything. Lots of them have come out of the woodwork and been like, Mike, like, don't feel bad. Like, I blew up my account. This happened. It's like, that's a symptom of, in my opinion, a bad investment strategy. I think maybe if you're in a trade, take 10% of your net worth or something and do that. It probably is, like, for me at least anyway, and for most people watching this, buy your index funds, spread it out, maybe buy some real estate too, buy a little bit in several buckets. And most people don't have the disposition for it either. I certainly don't have the disposition for that roller coaster. Even if I did, I don't enjoy it enough, like the highs and the lows of watching the price. If you're in it for the long term, in the long direction, you're not shorting, you're just long the indexes, you can sit back. If it goes down 10, 20%, you don't care. Just don't even look at it. Check it on a year. yearly basis, whatever, readjust your portfolio. If one stock's way overvalued, you can readjust your index funds. That's chill. That's what I want for people. That's financial independence. If you're trading actively, you're not really financially independent. You have a job if you're doing it well. And again, like the challenge there is like, how do you do it well? If some of the best guys on Wall Street and Bay Street sometimes still lose their shirts and make mistakes and don't outperform the index, like how many traders are up, with let's say no leverage. Say a trader was using no leverage, and he compared that to someone who just bought the NASDAQ this year and is up like 45%, or bought like the top 10 tech stocks, right? Like there's a lot, if that's a benchmark, most people aren't doing 50% in the first 6 months of the year, right? Like without taking massive risk over the long period of time. If you drag it out, Warren Buffett has done, there's been so many people who have done studies on this, but like fund managers net of fees don't outperform the indexes over the long term. There's very few hedge fund managers. So it's like if 98% of them fail. So if you're the 2%, if you're watching this and you're not like the most hardcore 80-hour-a-week trader, and you don't have a background and a PhD in this and all that, you're probably not going to beat the market over 25 years. And so why try? And then the question is, what's the value of your time? Like if I bill out $1,000 an hour, I've probably spent $1 million of my time learning to trade. That was a huge mistake. I'd be better off doing coaching, teaching other people how to do real estate, and doing real estate, and have made $1 million on my time, plus the return I would have made on my capital. So like for me, it's just doesn't make sense to trade. And for most people, it actually doesn't make sense to trade. And if you talk to most portfolio managers who, for a living, go in and analyze people's portfolios, what they find is that most of the entrepreneurs who are successful, rich entrepreneurs, they take money from their businesses, they put it into their stock trading portfolio, they buy a bunch of stocks, they think they're making plays, they talk about it over golf with their friends. Most of them lose to the index, almost all of them. If you talk to the portfolio managers, and I talked to several, they are losing. They would be better off taking that money and putting it back into their business in most cases. So that's what the data tells us. There's exceptions and anomalies, and there are some people out there who are geniuses and amazing traders, and like they dedicate their life to that and they develop an alpha edge. And to those people, my hat is off to them because that's a tough profession. Much respect for people who do that for a living. But most of my people watching this and watching the replay, you're not that guy. You're not that guy. Don't try to be that guy. Okay, back to the Q&A for a sec. Do you think Bank of Canada will raise in September? It's a flip of a coin right now. Maybe. I would like to see it, only because, and this is just me hopeful, wishful thinking, the alternative of leaving inflation higher for longer, which is what they're doing right now. They're slowly beating inflation back down to 2% target. Inflation is toxic to the bottom 2/3 of society. Like your old man on his pension, your retiree, your person working a job, making 60 grand a year as a teacher, or like whatever contractor, whatever your job, like the average person suffers so hard under inflation. It's such a hard tax on the backs of the middle class and the lower class that I really do hope that they raise again. I also selfishly, like this would also suck for me because I have a bunch of properties that I'm looking to dispose of right now. And so I would take a hit on that, right? But then at the same time, it would give me an opportunity to double down and buy more, right? I would dispose of some properties and buy more at great deals. So I would benefit from Bank of Canada hiking rates because it would push real estate prices down further. Every time they hike a quarter basis point, we lose about 2.5% in value of real estate. So these 3 hikes we just had are going to push real estate, if they haven't already, down about 7 to 10%, which means on an average $900,000 property, you just lost 100 grand, gone like that. The value of properties just dropped. So for me, I have an 8-figure portfolio in real estate still. That would mean a 7-figure loss in the value of my portfolio. And it's like, that's okay, because I can use that opportunity to go deeper. And then coming out of that recession, when rates come back down, I will be able to lift and make millions again. So it's about having a long-term perspective, about anchoring yourself in data and not being super short-sighted. Like people will panic and you don't want to panic. Panicking is how you lose money. Make a plan. If you have the property and you can cash flow, hold it, cash flow it. Don't panic sell. There were some people panic selling last year and I'm like, what are you doing? Toronto was down 20, 25%. I'm like, what are you guys doing? Don't panic sell. If you can get cash flow, hold. Anyway, people will do what they'll do. But yeah, there's a flip of a coin likelihood. So 50-50 likelihood, I would say that they raise it again. I would actually say, I personally think it's like a 70% likelihood that we'll get another hike this year. Whether it's at September or not, I don't know. But I think one more is coming at least. especially because the US just raised